Hey everyone, welcome back to the Money Mindset Show. Today we're diving into how to evaluate any stock before buying, using Tesla as an example. No complicated jargon, no fancy charts, just straight talk. With so many tools and platforms out there, websites, apps, AI-based tools, it's easy to find stock recommendations or even detailed analyses. They'll give you price targets, growth rates, and even tell you whether to buy or sell. But here's the thing, it's your money on the line. Before risking it, you owe it to yourself to spend a few hours doing your own step by step research. Today, I'll show you exactly how to do this using Tesla as our example. By the end, you'll know where to look, what to check, and how to decide if a stock is worth your investment. Step 1. Know what the company does and understand the business. First, go to the company's website or search for their business overview. Ask yourself, what does this company actually do? For Tesla, it's not just about cars. They're building EVs, batteries, solar panels, and autonomous driving software. That's their core business, but they're also innovating in energy storage and robotics. Why it matters. You want to invest in a company you understand. If their products and services don't make sense to you, it's hard to trust your investment. Step 2, look at financials. Key metrics to check. 1. Revenue growth. Check how much money the company is making and whether that number is growing. For Tesla, revenue has been climbing year over year. You can find this on platforms like Yahoo Finance, Google Finance, or Morningstar. Look at the past few years. Are the numbers going up or down? Consistent growth is a green flag. 2. Profit margins. Next, check profit margins. How much of that revenue turns into actual profit? Tesla has about 15% operating margins, which is solid for a car manufacturer but lower compared to software companies. 3. Debt to equity ratio. This tells you how much debt the company has compared to its equity. Tesla's debt is manageable, but if this ratio were too high, say above 1, it'd be a red flag. Why it's important. These numbers show if the company is financially healthy or if they're just surviving on hype. Step 3. Evaluate valuation metric. 1. PE ratio, price to earnings. Tesla's current PE ratio is over 113. What does that mean? It means investors are paying $113 for every $1 of Tesla's earnings. Is that bad? Not necessarily. High PE means people expect Tesla to grow a lot in the future. But it's a risk. If they don't grow fast enough, the stock could drop. For reference, the market average PE is 20 to 25. PEG ratio. This adjusts the PE ratio for growth. Tesla's PEG is about 2. Ideally, you want this below 1, but anything under 2 is acceptable for growth stocks. Price to sales, PFAS ratio. This tells you how expensive the stock is compared to its sales. Tesla's is almost 15. For context, anything under 2 is cheap and above 10 is pricey. Tesla is already in the red zone. It's expensive, but that's because people believe in its future. Compare this to competitors like Ford or Rivian to see if it's overpriced. Why it's important. Valuation helps you avoid overpaying for a stock, even if the company is amazing. Step 4. Analyze market trends. Tesla benefits from trends like EV adoption, renewable energy, and autonomous driving. But trends can change. Watch for government policies, new competitors, or slowing consumer demand. Why it matters. A great company in a dying industry is still a risky investment. Tesla's future depends on these trends staying strong. Pro tip, also watch for big picture stuff like interest rates. If borrowing money gets expensive, fewer people might buy Teslas. Step 5, compare to competitors. Tesla isn't alone. Look at how Tesla stacks up against competitors like Rivian, Ford, or BYD. Who has the better growth rate, profit margins, or market share? Why it matters. If Tesla's competitors are catching up fast, it might impact Tesla's future growth and stock price. Step 6. Insider activity and analyst opinions. Check if insiders, like the CEO or board members, are buying or selling shares. If they're buying, it means they believe in the company's future. Selling isn't always bad, they might just need to buy a new yacht. Analysts are split on Tesla. Some say it's going to the moon, others say it's overpriced. Take their opinions with a grain of salt. Use it as a guide, not gospel. Step 7. Decide for yourself. At the end of the day, it's your decision. Tesla might be a great company, but is it the right investment for you? Think about your risk tolerance and long term goals before pulling the trigger. Conclusion: to evaluate a stock, understand the business, check financial health, look at valuation, research trends, compare competitors, and assess insider activity. Tesla is a great example of a high growth company with risks, so always do your homework. If you learned something today, give this video a thumbs up and subscribe for more investing tips. What's your take on Tesla? Let me know in the comments. See you next time on the Money Mindset Show. Let me know if you'd like any more tweaks or additional details.